Interest rate risk management. Explain how interest rates are determined. The factors affecting interest rates are largely macroeconomic in nature. First one, supply and demand. Demand, supply of money. When economic growth is high, demand for money increases, pushing the interest rates up and vice versa. Second, inflation. Higher the inflation rate, the more interest rates are likely to rise. Third, government. Government is the biggest borrower. The level of borrowing also determines the interest rates. Central bank, that is RBI, by either printing more notes or through its open market operations, OMO, changes the key rates, CRR, SLR, and bank rates, depending upon the state of economy or to combat inflation. What are the various types of interest rate risks? There are 6 types of interest rate risks. First, gap exposure. Second, basis risk. Third, embedded option risk. Fourth, yield curve risk. Fifth, price risk. Sixth, reinvestment risk. What methods are used to measure the interest rate risk? There are different techniques for measurement of interest rate risk, ranging from the traditional maturity gap analysis to measure the interest rate sensitivity of earnings, duration to measure interest rate sensitivity of capital, simulation, value at risk. While these methods highlight different facets of interest rate risk, many banks use them in combination or use hybrid methods that combine features of all the techniques. Write a short notes on forward rate agreement, FRA. A forward rate agreement, FRA, is an over-the-counter contract between parties that determine the rate of interest to be paid or received on an obligation beginning at a future start date. The FRA determines the rate to be used along with the termination date and notional values. FRAs are cash settled with payment based on net difference between interest rate and the reference rate in the contract. An FRA involves two counterparties, the fixed rate receiver, that is short, and the floating rate receiver, that is long. Thus, being long the FRA fixed payer means that you gain when LIBOR rises because you have to pay fixed rate even if the LIBOR has increased. The fixed receiver counterparty receives an interest payment based on fixed rate and makes an interest payment based on a floating rate. A floating receiver counterparty receives an interest payment based on floating rate and makes an interest payment based on fixed rate. If we are the fixed receiver, then it is understood without saying that we are also the floating payer and vice versa. Because there is no initial exchange of cash flows to eliminate arbitrage opportunities, the forward rate agreement price is the fixed interest rate such that the FRA value is 0 on the initial date. FRAs are identified in the form of X into Y, where X and Y are months and the multiplication symbol is read as by. To grasp this concept and the notion of exactly what is the underlying in a FRA, consider 3 by 9 FRA, which is pronounced as 3 by 9. 3 into 9, 3 by 9. The 3 indicates the FRA expires in 3 months. The underlying is implied by the difference in 3 and 9. That is, the payoff of FRA is determined by 6 months LIBOR when the FRA expires in 3 months. The notation 3 by 9 is market convention, though it can be seen confusing at first. The contract established between two counterparties settles in cash the difference between a fixed interest payment established on the initiation date and a floating interest payment established on the FRA expiration date. The underlying of an FRA is neither a financial asset nor even a financial instrument. It is just an interest payment. It is also important to understand that the parties to an FRA are not necessarily engaged in a LIBOR deposit in the spot market. The LIBOR spot market is simply the benchmark from which the payoff of the FRA is determined. Settlement. Settlement, how to calculate settlement? Settlement equals to N into RR minus FR into DTM divided by DY whole divided by 1 plus RR into DTM divided by DY into 100. What do you mean by the term cheapest to deliver? Cheapest to deliver in the context of interest rate futures. The cheapest to deliver is the bond that maximizes difference between future settlement price, that is adjusted by conversion rate. This future settlement price will be adjusted by conversion factor and quoted spot price of the bond. It is called cheapest to deliver bond because it is the least expensive bond in the basket of deliverable bonds. Cheapest to deliver bond is determined by the difference between cost of acquiring the bonds for delivery and the price received by delivering the acquired bond. This difference gives profit or loss of the sellers of the futures. Next, profit or loss of sellers of futures will be calculated as follows. Future settlement price into conversion factor minus quoted spot price of deliverable bond. That bond is chosen as cheapest to deliver bond, which either maximizes the profit or minimizes the loss. Write a short notes on interest rate swaps. An interest rate swap is an agreement between two parties to exchange one stream of interest payments for another over a set period of time. Swaps are derivative contracts and traded over the counter. The most commonly traded and most liquid interest rate swaps are known as plain vanilla swaps. Example of interest rate swaps. Company A has converted fixed rate loan into floating rate loan, whereas Company B has converted its floating rate loan into fixed rate loan. This is called as swapping. Interest rate and currency swaps are agreements in which parties agree to exchange cash flows with each other. Swap agreements are entered into through private negotiation in which parties themselves decide the terms and conditions. Interest rate swaps are useful because they help in converting a fixed interest rate loan into floating interest rate loan and vice versa. How to value swaps or write short notes on swap valuation. An interest rate swap is worth close to zero when it is first initiated. After it has been in existence for some time, its value may be positive or negative. There are two valuation approaches when LIBOR or swap rates are used as discounting rates. The first regards the swap as the difference between two bonds. The second regards it as a portfolio of FRAs. Principal payments are not exchanged in an interest rate swap. We can assume that principal payments are both received and paid at the end of the swap without changing its value. By doing this, we find that from the point of view of floating rate payer, a swap can be regarded as a long position in a fixed rate bond and short position in a floating rate bond. So that VSwap means value of swap equals to fixed rate bond minus floating rate bond. VSwap is the value of swap and BFL means value of floating rate bond. BFIX is value of fixed rate bond. Similarly, from the point of view of fixed rate payer, a swap is a long position in a floating rate bond and a short position in a fixed rate bond. So that the value of swap is BFL minus BFIX. That means value of bond of floating minus value of bond of fixed will be the value of swap. What are the different types of swaps? Different types of swaps. First one, plain vanilla interest rate swap. The most common and simple swap is the plain vanilla interest rate swap, where fixed rate is swapped with floating rate. In case of a plain vanilla interest rate swap, party A agrees to pay party B a predetermined fixed rate of interest on a notional principal on specified dates for a specified period of time. Concurrently, party B agrees to make payments based on floating interest rate to party A on the same notional principal on the same specified dates for the same specified time period. In plain vanilla swap, the two cash flows are paid in the same currency. The specified payment dates are called as settlement dates and the time between are called as settlement periods. Because swaps are customized contracts, interest payments may be made annually, quarterly, monthly, or at any other interval determined by the parties. Next swap is basis rate swap. A basis swap is a floating interest rate swap. A simple example is a swap of 1 month LIBOR for 6 months LIBOR or 6 months MIBOR. Basis rate swap is a type of swap in which two parties swap variable interest rates based on different market rates. This is usually done to limit interest rate risk that a company faces as a result of having differing lending and borrowing rates. For example, a company lends money to individuals at a variable rate that is tied to LIBOR, London Interbank Offer Rate, but they borrow money based on Treasury bill rate. This difference between borrowing and lending rates, the spread, leads to interest rate risk. By entering into a basis rate swap, where they exchange the T-bill rate for LIBOR rate, they eliminate the interest rate risk. Next, asset rate swap. Similar in structure to plain vanilla swap, the key difference is the underlying of the swap contract. Rather than regular fixed and floating interest rates being swapped, fixed and floating investments are being exchanged in case of asset rate swap. In plain vanilla swap, a fixed rate is swapped for a floating LIBOR. In an asset swap, a fixed investment, such as a bond with guaranteed coupon payments, is being swapped for a floating investment, such as an index. Next, amortizing rate swap, an exchange of cash flows, one of which pays a fixed rate of interest and one of which pays a floating rate of interest, and both of which are based on notional principal amount that decreases. In an amortizing swap, the notional principal decreases periodically because it is tied to an underlying financial instrument with a declining principal balance, that is amortizing principal balance, such as a mortgage. The notional principal in an amortizing swap may decline at the same rate as the underlying or at a different rate, which is based on market interest rate of a benchmark like mortgage interest rates or LIBOR. The opposite of an amortizing swap is an accelerating principal swap. Its notional principal increases over the life of the swap. In most swaps, the amount of notional principal remains the same over the life of the swap. Write a short notes on swaptions. An interest rate swaption is simply an option on an interest rate swap. It gives the holder the right but not the obligation to enter into an interest rate swap at a specified date in the future at a particular fixed rate and for a particular specified term. There are two types of swaption contracts. A fixed rate payer swaption gives the owner of the swaption the right but not the obligation to enter into the swap, where they pay the fixed leg and receives floating leg. A fixed rate receiver swaption gives the owner of the swaption the right but not the obligation to enter into the swap, in which they receive the fixed leg and paying the floating leg. What are the features of swaptions? A swaption is effectively an option on a forward start IRS where exact terms such as fixed rate of interest, the floating reference interest rate, and the tenure of the IRS are established upon conclusion of the swaption contract. A 3-month into 5-year swaption would therefore be seen as an option to enter into a 5-year interest rate swaption 3 months from now. The option period refers to the time which elapses between the transaction date and the expiry date. The swaption premium is expressed as basis points. Swaptions can be cash settled. Therefore, at expiry, they are market to market of the applicable forward curve at the time, and difference is settled in cash. What are the uses of swaptions? Swaptions can be applied in a variety of ways for both active traders as well as for corporate treasurers. Swap traders can use them for speculation purpose or to hedge a portion of their swap books. Swaptions have become useful tools for hedging embedded optionality, which is common to the natural course of many businesses. Swaptions are useful to borrowers targeting an acceptable borrowing rate. Swaptions are also useful to those businesses tendering for contracts. Swaptions also provide protection on callable or puttable bond issues. What are the categories of swaption styles? There are 3 main categories of swaptions. Although exotic desks may be willing to create customized types, analogous to exotic options in some cases, the standard varieties are Bermudian swaption, European swaption, American swaption. Bermudian swaption, in which the owner is allowed to enter the swap on multiple specified dates. European swaption, in which the owner is allowed to enter the swap only on the expiry date, that is expiration date. These are the standards. These are the standard in the marketplace. Next, American swaption. American swaption is a swaption in which the owner is allowed to enter the swap on any day that falls within the range of 2 dates